Good afternoon. I'm Susan Weber, and joining Walker and Dunlop CEO Willy Walker today is Tope Lawani of Helios Investment Partners. They will discuss investing in the world's fastest growing continent, how advanced digital payment platforms are allowing African nations to leapfrog parts of the Western world, and how private capital has created economic and social value throughout the African continent. Thank you for joining us today, and now over to Willy.
Thank you, Susan, and good evening to those people in Tope's time zone over in Europe, and good morning to those in my time zone on the West Coast of the United States, and I'm actually in Mexico today. It's a real pleasure to have my old friend Tope Lawani with me today. Let me do a quick intro of Tope and then dive into our discussion. Tope Lawani is a co-founder and managing partner of Helios Investment Partners and co-CEO and a director of Helios Fairfax Partners. Prior to forming Helios, he was a principal at TPG Capital, a leading global investment firm managing private equity, venture capital, credit, and real estate investment funds. At TPG, Mr. Lawani had a lead role in the execution of several significant leveraged buyouts and venture capital investments, including the acquisitions of Burger King, Debenhams, J.Crew, and Scottish and Newcastle Retail. He began his career as a mergers and acquisitions and corporate development analyst at the Walt Disney Company. Tope serves on the boards of directors of Helios Tower, Vivo Energy, Excella, Zola Electric, OVH Energy, and Mall for Africa. He also serves on the board of directors of the Emerging Markets Private Equity Association and the END Fund, a leader in global health movements to tackle neglected tropical diseases. Mr. Lawani is a member of the MIT Corporation, the MIT School of Engineering Dean's Advisory Council, and the Harvard Law School Dean's Advisory Board, and has previously served on the Overseers Visiting Committee of the Harvard Business School. Mr. Lawani received a BS in Chemical Engineering from MIT, a Juris Doctorate cum laude from Harvard Law School, and an MBA from Harvard Business School. He is fluent in Yoruba, a widely spoken West African language. So, Tope, let's back up for a second here, my friend. Let's go back to Ibadan, the town where you grew up in Nigeria. Where is Ibadan? I guess it's Ibadan. I think I got that right.
That's good. Yeah,
Ibadan.
that's good.
And what was your childhood like growing up there?
Well, so first, thanks for inviting me, Willie. It's great to see you, not on a bike, and thanks especially to your guests for joining. So it's really good to be here. So yeah, look, I mean, I have to say I had a fantastic childhood. I mean, I grew up in Ibadan, which, and I went to a local kind of Nigerian primary school, 100% Nigerians, pretty much. But my dad worked for an international research institute. And so where I lived essentially on a campus, if you will. And on that campus were probably close to 100 nationalities. So in the 5 houses surrounding my home, my neighbors were, next door from Taiwan, Israel, Korea, Jamaica, Sierra Leone. So I grew up, in an extremely multicultural environment, and so just always was, from really the get-go, very always comfortable with people from basically anywhere. And then actually I went to a boarding school, also in Nigeria, in the middle of the country. So suffice it to say, it was not plush, but it was, what was interesting about the school was it was academically extremely strong, but it was government funded, government subsidized, so heavily subsidized. So it cost almost nothing to go there. And so as a result, you had in that school basically all strata of society. I mean, I went to school with the kids of the president, the vice president, all the heads of the, armed forces, but equally, a decent percentage of the kids of my school, a very decent percentage, were probably, the first kids in their entire family histories ever to go to school. They turn up to school with, all their belongings in in a sack of rice, if you know what those things look like. So I think, again, just this kind of childhood that I think was a little bit unusual and probably very difficult to replicate in this, just the way the world is these days. It was, extremely multicultural, extremely sort of socioeconomically kind of fluid. And I think that kind of just made me, I've always been fairly comfortable, to be honest, around people of any stripe, frankly. And I think that was, a result of that.
Was the plan always to go to the States or to Europe for college, or was there a path that would have kept you in Nigeria sort of for your entire career?
Yeah, I mean, look, it was not uncommon. I mean, statistically uncommon, but not uncommon if your parents were fortunate enough to be able to afford it for you to, you could get an excellent primary school, secondary school education in Nigeria. And depending on what you were studying, maybe university as well. But clearly, as time went by, it became harder and harder to get, sort of a world-class sort of education. So it wasn't unusual if your parents were able to afford it, to send you off to school, to university, as in America or in the UK. So for me, my family had always had more of a leaning towards the US versus the UK. I mean, families sort of break that way. My dad got his master's in Columbia, for example, etc. So I think going to university in the States was always on the cards. There was a moment when I thought I'd go to university, come here to the UK for university. That's a story for another day, but it was actually a pretty interesting insight into the nature of this society and the American one. But anyway, we'll save that for another day. But yeah, so I ended up going to university in the US.
And so you get to MIT, you're studying to be a chemical engineer. How's that transition from going from a boarding school in Nigeria to Boston, Massachusetts, Cambridge, and being a freshman at MIT?
Yeah, look, I mean, again, I think because of the way I grew up, to be honest, I don't really remember feeling too much of a culture shock. I mean, the workload was a bit of a culture shock, but but day-to-day life, I think, was just not, yeah, lots of things are different, but you sort of adapt to them, right? So lots of things were different. You adapt. It just different sort of different flavors. But and MIT actually happens to be, a fairly international place, and also happens to have, I think amongst those sorts of, large kind of research institutions, amongst the highest sort of rates of kids who are first in their family to go to college. It's an unusually high percentage. So it's a pretty diverse place as well. And so I think that was, other than, the workload, which was extraordinary, I think it was okay.
And did all of your brothers also go to college in the States, or did any of them stay in?
No, we sort of split. So that, yeah, as you rightly point out, I've got three brothers. So I'm number two of four. So number one went to UC San Diego. Number two went to University of as a Virginia Tech, and then went to grad school at Stanford. And then number three went to Edinburgh, here in Scotland, and then number four was the one who went to Virginia Tech and then to Stanford. So we all sort of scattered all over. But then, of course, all of them, with the exception of me, everyone then returned to Nigeria. After college and jobs, etc. Everyone sort of basically reconverged in Nigeria, whereas I sort of stayed in the US. And so we've always been in and out, but Nigeria has always been a pretty strong gathering point. They've sort of since scattered again, but Nigeria's always been a very strong force of gravity for us.
And why the desire to get a JD MBA? Because you could make up your mind on which degree was more important or useful, or because you really wanted to be the most overeducated person in the room?
I was young and I had energy, man. that was then. I wouldn't do it now, that's for sure. No, but so what? So look, the background to that actually was, so I started university in September of 1987. In October of 1987, there was a big sort of market crash, as I think everyone knows. And before that, I'd had no interest, knowledge, exposure, nothing about sort of financial markets or anything like that. But then, after that market crash, then followed the sort of the insider trading scandals with Ivan Boesky and Dennis Levine, and, Drexel collapsed, and you had Wall Street, the movie, and so on and so forth. And it was the first time, at least I think, where financial markets sort of made it into kind of the general interest media, right? And so, I just sort of read a lot about this stuff and, kind of got interested in sort of understanding it a little bit better, and sort of who did what to whom in the industry and so on and so forth. And it was then that I decided, probably because I read Barbarians at the Gate or something, I don't know what it was, but anyway, look, it's superficial things, but they all add up, right? But so I decided then that the private equity, or something as it was then forming, was a thing that I really wanted to do. And I've, and law school I found it was interesting. My mom's actually a lawyer, but she went to law school quite late. So I was sort of aware of her going through it while she was going through it. So law school was interesting to me. And actually at the time, lawyers were pretty pretty prominent deal makers, right? You have people like, Joe Flom at Skadden and Marty Lipton at Wachtell. And so they were in all of those sorts of stories. So I said, look, I'll, apply to law school because frankly, I was quite young when I was doing this. I didn't think I'd get into business school, but I felt business school was what I needed for the vocation, as it were. But probably I'd go to law school because I was probably too young and too inexperienced to be accepted at business school. I wasn't surprised that I was accepted I was grateful, but not surprised that I got into law school. I was quite surprised to have been accepted into business school. And then, and I just felt, okay, well, look, the two are one at the time. And in retrospect, I think what I learned about that is a bit different. But at the time, I felt like law school would be just because I found it interesting and for some intellectual stimulation. Business school would be to give me the tools of the trade. And I think as it transpired, I have to say that I think law school, for me at least, has been every bit as helpful in what I do, as business school has been. I mean, things like corporations and tax and bankruptcy and all that kind of stuff. So,
But you don't, do you have any relationships with your law school classmates? Because I certainly know you've maintained great relationships with your business school classmates. Are the people still part of your life? Or are they all off doing their thing?
Yeah, no, it's a really well, that too. It's a really interesting question, actually, Willie, because as you know, I have very, very close relationships with friends from business school, and I would say many more than I do friends from law school. But I do have some very close relationships with a very small, not very small, but a handful of friends from law school. But oddly, I'm much closer and more engaged with the law school as an institution than I am, with the business school. I'm really quite involved with the law school. I feel, I really do feel like it was quite transformational for me. I feel like, a legal education, especially in the US, and especially at an institution like Harvard Law School, I think is hugely empowering. And I do feel in a lot of respects that it was, as an institution, it sort of spoke to me a little bit more than business school did, whereas business school as a community of friends and colleagues, et cetera, I have much more affinity for, if that makes sense.
So you got out of HBS and you went to work for TPG, and you were there at TPG. Today we think about TPG and its name is synonymous with the very biggest and most established private equity firms. But back in the 1990s, when you joined TPG, it was not KKR or Blackstone or Apollo at that time. It was an emerging firm that had done well, but had none of the sort of the brand recognition that we have with TPG today. Talk a little bit, Tope, about when you joined TPG, did you think that you might stay there for your entire career? Or was there always something in the back of your mind of, I'm here to learn a lot, and then I might take that on to go back to either Africa or go to Europe or do my own thing? Or when you got to TPG, it was like, this is a great job and I might end up being a partner at TPG and spending my entire career here?
Super question, Willie. So you're right. When I joined TPG, I think I was the 11th person there. It was a very small place, but I would say that it was, to my mind at least, I think one thing, I think to my mind, it seemed to be a relatively sure bet because, Bonderman, Coulter, and Price, in my humble opinion, I think are, from a pure investment capability standpoint, I think they're as good as they're out there. They had an incredible track record, at least, David and Jim did from Robert Bass Group. And so it was a bit like, a big brand in a small company, right? And so from that standpoint, it was just the best of all. I have to say I had the most extraordinary time there. I mean, they let me do things that no 25, 26-year-old had any business doing. So that was a phenomenal experience. And I have to say that when I sort of settled into it, I loved my job. And for, a period of a number of years, I felt, yeah, this works just fine. I love living in San Francisco. I love the people I work with. It's great work, and and I'm well compensated for it. So what's not to love? But then interestingly, in my application for the JD MBA program, which I wrote when I was 20 years old, my essay subject, actually, or my whatever that you want to call it, was actually about wanting to be essentially a private equity investor in Africa. Weirdly, and I actually stumbled across it when we were moving house a couple of years ago. And I'd actually forgotten that, but clearly it's something that, from the moment I got interested in markets and in investing, I sort of always overlaid it against doing the same in, the part of the world that I, kind of know best, feel most comfortable in. So I think that, there did come a time at TPG where, you start to sort of, where I started to feel a little bit, I would say, sort of dislocated, if that's the right word, right? Just feeling like, this is great, but then what? I'm going to be sort of 75 years old and living in San Francisco and retired. Look, nothing wrong with that, but it's just not, I just didn't understand, starting to feel a bit distant, if you will, from my roots. And I think that was the time when I realized, okay, look, I do need to kind of, reorient here. And look, again, I mean, Bonderman and Coulter, and they've been phenomenal, right? And they, I decided that I wanted to move to the London office of TPG because I wanted to be closer to Africa. And I was fairly transparent about that. And they, and that was, I wouldn't say it was okay with them, but suffice it to say they made it their idea, and then, and then kicked me out. So I moved to the London office.
And was there anything at that time, watching Bonderman, Coulter, and Price building TPG, Topoi, that you saw and thought was distinct from the other PE firms, and that you took that to the establishment of Helios? So something that sort of said either the tone, the way they invest, the way they run the firm, the way they bring in operational expertise. Well, what was there some piece to the TPG magic beyond just great people that you said, if I end up doing my own thing and then ended up doing Helios, that you would sort of take from that TPG experience and implement on your own firm?
For sure. And, look, for sure. And there's a but at the end of it, right? And I think that, I think what it was, so what they did really well was just, hire, pretty creative people who were, fairly entrepreneurial, had a lot of hustle, and, and just empowered them to go and find things that seemed interesting, because they themselves are, pretty interesting people, them pretty well, right? So they did that, and I think that made it sort of and in the way that we evaluated investments and discussed investments, it was as pure sort of a contest of ideas as you could get. So you sit in an investment committee, and it's just really sort of it's really kind of a tearing apart of the idea, not the person. There's nothing personal about it, but just really sort of the back and forth on the idea and just getting to the truth. So this highly creative, highly entrepreneurial, truth-seeking sort of approach to things, I thought was great. Now, the but at the end of it is that, in the end, right, there are limits to the scalability of that. And if you have a firm of 11, 15, 20, 30 people, of these sorts of this kind of characteristic, all mostly sort of sitting in one office, in San Francisco, I think it works very well. But when you then try to sort of preserve that, and you've got lots of outposts in lots of places. I mean, this is an organization, Willy, that you're familiar with, right? On all continents. So in Latin America, you're in Asia, you're in Europe. It does start to fray. I think that there are limits to sort of to how you can grow a freewheeling investment organization, and so I think that gets manifest in sort of in all kinds of stresses in the system. I mean, TPG has clearly sort of grown out of it a long time ago, and I think they're, as far as I know, it's a well-oiled machine. But I think the lesson that I took away from that was, yes, I think that's a kind of person that you want to have in your firm, but really think hard about physical separation of your deal team. So we have an office in London, one in Lagos, one in Nairobi, and a small one in Paris. And, in Lagos and in Nairobi, we have, members of our portfolio operations team, and that works really well. We don't have any investment professionals in either Lagos or Nairobi. And I'm not saying that will never change, but I think it's this sort of aversion that I think I've developed to sort of having people scattered all over the place, making, in private equity, it's not, we might think it's what's in the PowerPoint, but before the PowerPoint gets printed, there are numerous, individual decisions and judgments that have been made along the way. And when you're blind to that, and you're not in the hallway and chatting about the deal and getting the full contours of it, there's risk there. So anyway, so look, in a nutshell, I think the kinds of that creativity, I think, is, especially in our market, you need that creativity, that flexibility, and that adaptability, but it imposes limits on the institution.
So before we move from TPG to Helios, I need you to tell our listeners about how you got into the J.Crew catalog.
You swore that this would not come up. In fact, did I get this? In fact, I don't recall.
Because I think when you told me you were going to come on and do this, you said the one thing we're not going to talk about is how I got into the J.Crew catalog. But I want you to tell a story about doing the buyout of J.Crew and then being asked by J.Crew to be in their catalog.
No, that was actually highly embarrassing. But so actually the history of TPG's involvement with J.Crew is that a dear friend of mine, Carrie Woods, who's a film producer, happened to be married to Emily Woods, who's the founder of J.Crew. I mean, her father funded, but she really was the driving force, the driving spirit behind it. And when her father was sort of getting on and needed to sort of think about transition, and she was interested in getting out from underneath his shadow, if you will. She was keen to sort of find a way to to buy the business, and so. Carrie, through Carrie, Emily and I sort of chatted a bit about it. And I said, well, I know these guys in San Francisco who might be just your people. And so we went, met with Coulter and sort of had that dialogue. And that's how we ended up how J.Crew ended up. So that was actually the first deal that I worked on at TPG. And I was actually still at business school. I was in my 4th year of grad school at the time. And so I was working on that deal part-time through my last year. And then it closed in my first full year of full-time work at TPG. But anyway, so during the course of all of that, Emily decided that she needed to have me in the catalog, which was highly embarrassing. But I did get paid for it. I got paid $300 for it because I think by law you have to get. I did get paid.
I would have thought there'd be some conflict about being on the ownership team of the company and being paid to be in the catalog. I love that.
If I'm going to be in the catalog, you're going to have to pay me.
That's great. So you're already in London working for TPG, and you decide to go form Helios. Talk for a moment, Tope, about raising that first fund. You clearly had a fantastic track record, but anybody, I don't care whether you have the pedigree and the background that you have, anybody who's out raising a first fund, we've all heard it's probably, it's one of the most challenging things in the business world, unless for whatever reason, there just happens to be a moment in time where you can jump out and just go, let's do it. Yeah. So talk about raising that first fund, particularly given that it was a first fund that was one of the first PE funds exclusively focused on Africa. It's one thing to say, hey, I'm going to go take everything I learned at TPG and have been doing at TPG in London, doing European buyouts and US buyouts, and say, I'm going to raise Tope Lawani Fund 1 to do what I was doing at TPG on my own. But now all of a sudden you say, we're going into Africa. And up until that point, I think I'm correct in saying nobody else had a dedicated buyout fund focused on Africa. So talk a little bit about raising that first fund.
Yeah, the thing about that was, I mean, there was probably some benefit of just naivete, I think probably helped, to be honest, because I think a fund like that, first time fund, in a pretty, niche, shall we say, market, I think is either impossible or it's easy. There's no such thing as it's in the middle, right? It's either just, it won't happen, or you might just stumble into some blind luck and it happens, fairly easily. I have to say that we were in the second category, and for a simple reason that, as you say, fortunately, based on just the prior experience that I'd had at TPG, primarily in the US, because I'd only been at TPG London for a year. So primarily the network was in the US. And testimony frankly, to the US, which is a distinguishing feature of the US versus any other country in the world, people make bets on people and they take risks on people in a way that, might not immediately be justified by whatever else. So what we did then was we approached, they were the only group of institutions that were actually in the business of investing in Africa, and maybe in funds that might do things in Africa, et cetera, were development finance institutions. So, like the IFC, OPIC at the time, which is now called DFC, CDC, which is the UK's equivalent of DFC, CDC, the UK's development finance institution. So you have the development finance institutions. That was sort of it. And so we approached, that community and got fortunate with CDC, OPIC as it was then, and the IFC, although the IFC actually came later. And then, but really what happened was it was just the support of, a number of, ultra high net worth individuals that we had done a lot of work. So, Bonderman was an investor, Coulter, Mark Lazary, who runs Avenue. And frankly, they're sort of, Soros, we'd done a few things with Soros, and they were, hugely supportive. And then oddly, and so that network, then led to sort of, a few meetings with certain hedge funds that we knew a little bit in New York. And of course, hedge funds are not really in the business of investing in private equity funds. But, because of the novelty of the strategy and an interest in perhaps, getting some exposure to sub-Saharan Africa or to Africa broadly, and this being kind of the least bad way of doing it, we were actually able to raise, a fair bit of money from hedge funds, weirdly, in that fund. So we really ended up in a place that was about a third development finance institutions, a third hedge funds, and then a third what I would call, ultra high net worth individuals, family offices, all of whom were in the investment business. So that was the first fund. Now, so again, we had nothing really to show for it. I mean, I made the argument at the time that, well, we know Africa and we know investing. So of course we know investing in Africa, which is actually not necessarily the case, but I think we were able to do it on that basis. And then the challenges sort of come after that, right? When you then need to sort of demonstrate that you've actually done something reasonable with that first fund.
It's funny when you say that you had a number of hedge funds that invested early in your fund. We had a bunch of hedge funds get into our IPO, and they weren't in it very long.
yeah. I've learned lessons about that too.
Exactly. Little did I know that when they said, "Hey, we're going to take a piece of the book," that was not exactly what I should be listening or hoping to hear.
Yeah.
So one of your earliest investments, Topoi, was in a tower business, HTN Tower in Nigeria in 2005. Talk a little bit about that investment, which you moved out of in 2016. It was a fantastically successful investment, and that's now part of IHS Tower, publicly traded company. But it led to other tower investments. But the reason I want to focus on that as our kind of launching point here is why private equity in Africa has such opportunity here, in the sense of buying into. I mean, yes, you could have been an American tower back in the 1980s, just like you could have been in HTN Tower in Nigeria in 2005. And so, yes, but today there's so much capital behind the cellular industry that you really need to be able to write massive checks to be able to be in that billions and billions. Whereas here you are in 2004, relatively recently, and you get the opportunity to invest in the Nigeria Tower Company that becomes a huge success, that then leads to another investment of a tower company across Africa. Talk about that for a moment.
Yeah, look, I think a point that I used to make, I remember saying this to an investor some years ago, was that, if private equity existed in the US in the mid 19th century, all of the Vanderbilts and the Carnegies and the Rockefellers, et cetera, wouldn't have existed. Private equity firms would have built the railways. They would have, built the banks. They would have done all of these sorts of things, right? And to some extent, that's sort of where Africa is. There's a lot of whether it's infrastructure in a roads and bridges sense, we'll hold that aside, but just economic infrastructure that needs to exist, that we know it needs to exist. It will exist at some point, and someone's got to build it. Now, in some cases, so someone's got to build it, right? As opposed to sort of buying it when it's already hugely mature. And I think towers was a really good example. We actually sort of stumbled into the towers opportunity in a way, because my partner and I were bidding on a mobile license, an actual operator license in Nigeria. And so we're going, doing, MTN had already won their license, Econet had won theirs. There's a third one up for sale. And so in doing all the analysis and trying to get the financing together and so on and so forth, it dawned on us that the vast majority of the CapEx was basically steel and concrete to build these towers, right? So, well, if that's what we're doing, and MTN has to do it and Econet has to do it, and coverage in the country at the time was, 10%, 15% geographic coverage, and population coverage, maybe even less. Then it's crying, and in an environment where capital is scarce, cost of capital is high, and the operational headache of running a telecom tower, because if the power supply is unreliable, diesel generators, all that sort of stuff, it's crying out for a shared infrastructure solution. So we lost the bid on the mobile license and immediately decided what we need to actually really build is a towers business. And so and that's how it got started. So we approached MTN to buy. MTN had at the time something like 800 towers in the country. Now, they've got many thousands. And so we approached them about buying their towers. They sort of hemmed and hawed, and we said, well, forget buying existing towers. 95% of the towers that need to exist don't exist. So just focus on building the ones that don't exist. And so we, negotiated a build to actually, copy pasted, found on the internet, sort of build to suit agreements, master lease agreements, site lease agreements from, Crown Castle, American Tower, etc. Cobbled together the contracts that we would use, got some engineering drawings from, that we paid for. And, we're able to negotiate sort of the first build to suit agreement with one of the mobile operators in Nigeria. And then, which is essentially a framework agreement. And then we sort of built it from there.
Well, I was just going to say, is there anything that's fundamentally different about that business doing it in Africa versus doing it somewhere like in the States? Is there something that the industry in the US came up out of a landline business, therefore the location of the towers was distinct, and then when you're doing it kind of with a blank sheet of paper in Africa, it presents the opportunity to do things in a different way?
I think the two differences. One is the one that you identified, which is, and this applies to a lot of the impact of innovation generally, right? Where landline penetration in Nigeria was about 1%, probably not more than 1%, possibly less than 1% before the first telecom tower, before the first mobile operator licenses were issued in around 2003. So less than 1%. And so what that meant was effectively you could build a telephony system from scratch. So it means that there are no limitations. There's no place where there's no place where there's coverage or where they're already being served and I've got to find pockets. It's just everywhere, right? So that's one difference with the United States. Even when the United States was, when the towers business was just launching in the US. The other very significant difference is that in the US, it's an operationally simple business, right? It's, you sort of build a tower, you plug it in, the power comes through, and you focus on sort of selling, space on the tower to your tenants and collecting the rents. In Africa, and so it's not particularly operationally complex. And so it's a financial deal, financial engineering. You can sort of, you can think of it almost as real estate, which is what it is. In our market, it's really an operating business because every single tower has maybe or maybe not a grid connection. It has a primary source of power, which is probably a diesel generator, has a backup for that diesel generator, which then means there's a whole industry around keeping the diesel supplied and monitored, because of diesel in a tank is a valuable commodity. And so security, so there are all sorts of ramifications of that, which mean that the barriers to entry are much, much higher. You and I could decide tomorrow that we wanted to start a towers business in Colorado. And I think we could probably build a few, maybe not that many, but we could build a few and make some money. You couldn't do that in Africa because the operational complexity is materially higher. And as a result, the trust that the operator has to have for the mobile operator has to have for the tower co is that much higher. So credibility is at a real premium. And that's why you're not going to see a massive proliferation of tower companies in Africa. You'll see a few which exist now and they'll do well. But the barriers to entry are very high.
So after being so successful in the towers business, both in Nigeria as well as in your broader Helios Tower company, which is in, I believe, 7 countries, you decided to invest in Telecom Kenya, a fully integrated landline cellular internet provider in Kenya. Why, if you will, go into the sort of, if you will, vertical integration on the telecom side in Kenya rather than staying in the cellular side as you had done both in Nigeria as well as across the continent?
Yeah, look, candidly, Willy, to be honest, I think under normal circumstances, we probably wouldn't have. So I'll tell you a bit about the history of that investment. So Telecom Kenya was acquired in majority, not 100%, by France Telecom, Orange. It used to be owned by the Kenyan government. So they bought a, I don't know, 60% odd interest for, $300-400 million. They ended up putting in, over the years, an additional couple of $100 million. And so, they were probably invested about $700 million all in, France Telecom was, into Telecom Kenya. And Telecom Kenya was getting hammered by Safaricom, which is the dominant player in Kenya, and to a lesser extent by Airtel, which is the number 2 player in that market. And so France Telecom decided that they just, no mas, they just needed to get out, right? And so they approached us about buying it. And we looked at it and said, look, same point you made, gosh, do I really want to be in the landline and the mobile and the this and all of that in a world where my relative market share is so low, etc. And so we actually said no. They then, about a year later, they approached us again, and again we said no. And then we got a call from the Kenyan government because we'd invested in Equity Bank, was a great success in Kenya. We'd done a couple of things there, and I think the government the market had basically come to embrace us, I guess, as force for good and a solver of thorny problems. And so the Kenyan government called and said, "Boy, it'd be great if you could figure something out because these guys are threatening to just literally pull the plug and and go home." And so we thought, look, okay, well, let's just tell them what it would take for us to do the deal. And we basically said, look, we'll take it for free, and you will pay us, 100 or essentially pay / guarantee, ring fence something like 150 odd million dollars of costs. And then, and then we could see value with that, right? We could see value in, in some of the assets, some of the core assets like towers, telecom assets, but non-core like the towers. And we felt that if we could achieve, the primary thesis on the mobile side was to see if we could achieve consolidation with Airtel, the distant number 2. We were a distant number 3. So if we could buy that company for zero, right, and consolidate our mobile operations with Airtel's, then all of a sudden, you get rid of a lot of redundant costs, your relative market share goes up, interconnect, which is a big source of revenue shift between one carrier and the other, starts to improve, and then you can make money on the mobile side. You can release cash on the tower side, and then there's some strategic assets like landing stations for undersea cables and so on and so forth. And so the thinking was you wouldn't quite disaggregate the business, but you'd essentially disaggregate the business, right? Now, it hasn't transpired. A key part of that thesis hasn't transpired. We haven't been able to do the consolidation with Airtel for reasons that are the usual regulatory, all kinds of things. But in the end, it'll be a good investment for us simply because of the terms of the deal that we did.
Talk about those landing stations for under submarine cables, because I saw that your partner Orange is working with PCCW Global and Peace Cable to put it. I mean, when I was reading about it, Tope, I was trying to figure out how you do this, but they're laying 12,000 kilometers of undersea cable from France to Kenya and up to Pakistan to basically connect Europe and the Middle East via this cable. And then that same cable is going to come out of Kenya and go all the way down to South Africa. Do you all invest in those types of ventures? And I guess more importantly, what's it tell you about the future of telecommunications and the internet in the continent?
Hugely important, Willy. So not only is that one that you've just described happening, there are two other projects. One that's being funded by Google, another being funded by Facebook, that are coming down the other coast, sort of the West Africa coast as well. And so in short order, you're going to have I don't know how many fold, but probably orders of magnitude increase in capacity, in sort of undersea cable capacity, which basically means, how do you connect? Let me give you sort of some anecdote, right? The top 50 websites in Nigeria, the people in Nigeria access, the top 50, which all happen to be Nigerian websites, Nigerian publications, et cetera, all of them are hosted in either Europe or in the US. So when I go to the website of, the Daily News, right, which is, or Business Day, which is a Nigerian newspaper, and I'm sitting in Lagos and I'm on their website, the data goes to Chicago, the request goes to Chicago, the data comes back, right? So you've got latency, you've got costs, you've got all of it. So Africa has the highest rates of, highest data costs in the world and highest rates of latency and just lowest performance. And so what it means is that you can optimize as much as you want on the terrestrial side, but if the uplink to the rest of the world is not there, then that's the rate determining step, right? So I think what these undersea cables will do, it will be to completely transform the rate at which sort of data consumption and data rates, in Africa. And you think about what the implications of that are. So, towers, right? Towers, you can, if a mobile operator needs more space, in order to host sort of increasing data content. They'll probably rent more space on your tower, so that's probably good. Data centers, the force of the increasing consumption of data domestically, plus of course the desire that you see everywhere in the world for data sovereignty and people wanting sort of sensitive data to be hosted in their own country, creates opportunities in data centers, terrestrial fiber, etc. All of that enabled by these giant sort of undersea cables that are emerging. So in theory, we might invest in the undersea cables. I mean, it's in the range of the sorts of things that we might do. We happen not to be looking at any of those three, but all the effort that we're doing in the whole digital infrastructure space, data centers, fiber, towers, etc., we think we'll have that as a tailwind.
So let's switch from telecom to energy and oil. You're an investor in Africa Oil, which is upstream oil exploration. And then you own Vivo, which I believe is the largest downstream gas station operator in all of Africa. Talk about, if you will, upstream and why that's attractive to you, particularly given oil being at over $100 a barrel. And then the downstream, I'd always thought that the downstream business of owning service stations was a pretty thin margin business and that nobody really liked that end of it. Is there something that's unique about being in that part of the business in Africa that provides the opportunity for ancillary revenues that just don't exist in more mature, established markets like Western Europe and the US?
Yeah, look, I'll give you a quick answer on the upstream so I can spend a bit more time on the downstream because I think the story is a bit more interesting. So on the upstream side, it is true that we've made historically a few investments in upstream oil and gas, but we haven't done one now in maybe 8 years, maybe 7 years, something like that. And look, you might say, duh, right? The reasons actually that we felt, despite the dependence on the commodity price that you can't predict, you can't really truly hedge in any real way, there's still reasons why we felt that we were going to be able to sort of sustainably make money in that sector. And actually overall, we haven't lost money. We made a bit of money in all our, in totality in our oil and gas investments. But, for reasons that have to do with just economics and the private equity kind of model, and then, of course, more, in recent years, by just the climate imperative and our view that, all roads kind of lead to Rome in this regard, we're not making investments in the upstream sector anymore. Downstream is pretty interesting. So Vivo, as you rightly point out, was a carve out we did, probably the most complex deal I've ever worked on, and that's saying a lot. Was a carve out we did of all of Shell's petrol stations across Africa, excluding South Africa. So there were 16 countries, but there was no company there. It was just, there were probably 24 companies that held these assets in them. And so we had to buy all 24 and create an actual independent standing, company out of it. But what's interesting, and which we did, and we've since added, we bought some, some sites or some businesses from Engen as well. So now Vivo operates in 23 countries, 16 or 17 of those are Shell branded stations. And then the balance are Engen branded stations. But what's interesting about the downstream business in Africa versus, say, in the US is that in the US, by and large, petrol stations don't make money on petrol. They make money on, on the food and sort of beer and cigarettes and chocolates and whatever else that people are buying from, from the shop. And that's because, the downstream business, it's just been competed away. So that you're not going to make money on commodity. In Africa, though, it's quite different. We make very, very good margins on the fuel, right? And the reason that's the case is that the way in many markets, Africa is a net importer of refined petroleum products, right? And in many markets, because the marketers, the importers, so Shell, for example, our business, Vivo, have a fair bit of market power. The governments in many places have actually decided to regulate the business. When we first saw it and said, gosh, regulated pump prices, that's a disaster. We're not going to get involved. But actually, when you think about it, what gets regulated is the margin. So in a liter of gasoline, of PMS, for example, probably 8 cents is what is the margin that we get. The rest is the price of crude, transport, refining, taxes, etc. So if the government really wants to adjust the price of the pump, they don't get a lot of mileage by shrinking the regulated margin. They could sort of say, look, our margin is no longer 8, it's now 7. And so they don't get a lot of mileage. But on the other hand, if they shrink the margin to 7 and we decide, actually, you know what, we're just not gonna sell at that price, right? Then the country grinds to a halt. And so there's actually a pretty good detente, and sort of mutual understanding on both sides that leads to a fair result. So the way you make the way that the market operates in most African countries is you basically have a fixed margin that and that margin, the dollar quantum of that margin inflates over time. So we're going to make $5 or 5 cents in this market. It'll inflate to 5.0 something cents and then 5.0 something else cents. And so it's actually a quite protected margin. And then the challenge becomes, because it becomes making money on the ancillaries in a market where, you know, it's not a rich continent, right? People aren't buying that much. They don't spend that much money on sort of chocolates and beer and cigarettes, et cetera, and, you know, as they do in the US. But it's a fantastic business, actually. I think it's publicly disclosed that we've actually agreed a deal to sell that business to our partner. Actually, we did it with Vitol, which is, you know, the world's largest energy trader. They've been great partners, and then it's been announced that there's a deal for them to, you know, to buy it. So it's going to be taken private soon.
So as I think about you not having done an upstream oil deal in quite some time, it makes me think about the fact that your funds, and being focused on Africa and sustainability and all of the things that are attracting so much capital these days, that, I mean, if you will, the Helios funds are sort of in position 1A as it relates to where sustainable capital, socially conscious capital would like to go. Is that limiting some of the investments you make down in Africa because there's sort of, you know, you can't be in dirty fuels, if you will, or anything else that sort of says, if we want to continue to raise this type of capital from the large institutions that we have a great track record with, we must be very conscious of what types of investments we're making?
Super question. Look, I think the short answer is no, actually, because we're quite fortunate in that, you know, most of the things that are likely to make money and to make money sustainably and in a private equity kind of cadence, you know, are things that, and to do them in Africa, are things that in any case are going to be pretty highly impactful, positively impactful from a social and economic development standpoint. There's one exception to that, right, which is slightly uncomfortable, and it's a very interesting one, and it's in this energy space. So we talk about upstream, we talk about downstream. Well, there's a bit in the middle, which you guys in the US will refer to as midstream. And what so Africa, you know, in the push, right, so a zero carbon end game, which I think we're pretty aligned with, there's a risk that Africa runs of being essentially I'd say disenfranchised, because, you know, if you're in Germany, there's enough power to go around, more or less. And so the debate is about swapping, you know, more polluting sources for less polluting sources. And, you know, that's a reasonable debate. And as, you know, as certainly, that's an easy one. In Africa, there's not nearly enough power to go around, right? And you're not going to power, you know, an aluminum smelter or a glass, you know, or glass factory with, you know, with wind power, right? You're just not. And so you need much more high energy content and, you know, fuels to power that. So we're quite interested, and we have made recent investments in the whole. So we believe strongly in natural gas as a transition fuel. So getting people off coal, getting people off diesel, getting people off heavy fuel oils, which is sort of what people use in industrial settings now, you know, to replacing those with gas. And then ultimately through the same pipes, you could probably deliver, whether it's hydrogen or biomethane or whatever it ends up being. And but that's an area where we do have certain investors who are, you know, longstanding partners of ours that are ambivalent about that. They say, they sort of take a view that, well, if it's gas, I'm not interested, right? And so we need to think a little bit about that, because we think actually from a development standpoint, for Africa's sake, we think it's imperative. And so what we will not do is say, okay, well, we're just not going to do that, because look, you know, the job that I'm in is to sort of help the continent develop. And I think if that's an important element of it, then we'll find a way to do it. But that's the place where I would say the shoe doesn't quite fit. Anything
on nuclear?
No, not yet. Although, you know, as part of my other stuff, I do a lot of work at MIT, and look, there's a lot of innovation that's going on in the sort of the small, you know, basically the small nuclear, you know, space. And I think, you know, who knows, but it wouldn't be surprising to me if in the next 10 years, There are workable, and sort of relatively sort of portable, if you will, low cost sort of, nuclear generation facilities that can be relevant for our market. But so far, nothing. I think the costs are just prohibitive. The scale is prohibitive, and we don't have the economic density in these, in these individual markets to be able to warrant it. And, look, and we also have, by the way, there are the value chain issues, right? There's a generation side, but transmission links aren't great, distribution grids aren't great. And so I think distributed power, at least for residential, is going to be the way. It's good distributed solar, wind. I think that rebuilding a whole grid and all of that, I think is tough. Same reason we don't have landlines.
Talk for a moment, Tpay, about Tpay, because I find it to be fascinating with a population across the continent that is so underbanked, yet overphoned, if that's it. I've never thought about calling it an overphoned population, but where you've got this just, cell phones are ubiquitous. They're everywhere, yet you have such a huge percentage of the economy that is not in the banking system. And therefore something like Tpay is the perfect payments platform to be able to allow people who have their cell phones to be able to actually transact with one another. Talk about that.
Yeah, look, banks are in big trouble, right? I'll give you just another anecdote. So there was a study done in Malawi and in Uganda. It just happened to be in those two countries. The point applies pretty much everywhere else, where they went through a number of banks, right? And sort of figured out, look, what is the cost of a basic savings account? So you just put your money in the bank account and it's just there. You earn a bit of interest and there's a sort of cost of maintaining it. And what they basically found was that more than 85% of the population, this is the Uganda example, 83 or 85 of the population of Uganda, the adult population, did not have enough in savings for it to be profitable for them to put their money into a basic savings account. Said differently, they would lose more money in cost than they're making in interest, 83% of the population. So they're not, forget the banks as they are will never ever be relevant to the vast majority of the population. So banking penetration across the whole continent right now is probably 30-odd%. Mobile penetration is probably getting into the 90-ish, and more importantly, smartphone penetration. Right, smartphone penetration is now over 50%. In some countries, it's actually quite a bit higher than that, but that's growing extremely rapidly as the cost of smartphones is coming down. And so with that, it's pretty obvious, right, that it's really obvious that banks, I think traditional banks, will have a very significant problem because the ability to transact, whether it's Tpay, whether it's InterSwitch, which is another one of our portfolio companies in Nigeria, Fowry, which is one of our companies also in Egypt. It just, people already have the banks in their hands, and it's lower cost, it's fast, it's easier to deal with, and you don't need to be. When you walk into a bank, if you're not sort of well dressed and people look down on you. No one looks down on you when you're banking on your phone.
So you've also invested in something called Bayport, which is basically a consumer credit company. But I mean, what fascinates me about Bayport, Tpay, is that it's consumer credit, but at a very low credit level. And so my when I read about it, I sat there and said to myself, man, underwriting their customers, figuring out whether you're going to do a $20 credit card, extension to somebody who is in the unbanked community, who is using their cell phone and accessing Bayport's credit. What are the algorithms that allow you to say, I'm going to give money there?
Yeah. So Bayport's a special case, right? Because the way Bayport provides its credit, so it's what we would call a payroll lender, not a payday lender, a payroll lender. And so what they do is they basically go to employers, so mostly government employers, in some cases large multinationals, and they do a deal with the employer. So they might come to Walker Dunlop and say, look, we're going to do a deal where you authorize us, right, to basically provide loans to your team members, right, which we can then deduct payment for at source. Right, so that when the paycheck comes, Walker Dunlop will essentially take the $20 or whatever is due that month, send it to our Bayport, and send the balance to the, to the team member, to the employee that, that has the paycheck. And so credit losses in that model are extremely low. I mean, really low. It's like 1 or 2%, because it only happens when people lose their jobs. I mean, there's some, or there's some fraud or something like that, but it's extremely low. Now, Bayport has its other challenges, because as do all non-bank financial institutions. When you're non-bank lenders, I should say, if you're a non-bank lender, you got to finance yourself somehow. And I think our experience in Bayport has been that the underdevelopment of the capital markets, the debt capital markets in Africa, especially the local currency debt capital markets in Africa, has actually been an inhibitor on the growth and profitability of that business. So that's a separate sort of lesson learned that, that is relevant to Bayport. But from a model standpoint, it's a fantastic model. But I think your point is still relevant, though, because there are a number of credit providers that do it exactly as you described, by algorithm, by, they sort of assess phone pattern use, phone usage patterns, et cetera, et cetera. And look, we've looked at a few of those, and I have to say that, the jury's still out. The jury's still out, because in many cases, it's sort of what in the olden days people used to call evergreening, right? How do I know that that last loan was paid back or just another one borrowed, right? And so you see these companies showing rapid rates of of asset growth, but I'm not so sure what the credit quality is, and I'm not sure when we'll really know whether these algorithms actually work.
So when I was doing research on Helios, you all were named the firm of the year for Africa by Private Equity International. And I said, wow, that's really fantastic that they won that award in 2021. I then realized that you won it in 2020, 2019, 2018, 2017, 2016. And it's really quite something what you have done. When you think about the amount of capital you've raised, Tope, the investments, because you're doing big, infrastructure investments, the checks that you're writing are probably typically larger than sort of emerging firms would have been way back when you were first starting Helios. And now your last fund, I think, was $1.2 billion, and you're about to raise fund 4 right now. Yeah. Is there anything just that's very different as it relates to either the size of the checks that you need to write because you're doing more infrastructure plays than operating company plays, and then also the realization of, I noticed that a number of the companies you've taken public rather than doing industry trade sales, whereas in the US public private equity world, probably, and maybe I'm wrong on this, but my sense is, yes, some do public exits, but often it's the company is sold off to some big, operator in that space who's doing a strategic purchase from the private equity firm. Is that a fair kind of, are the checks bigger to get into it? And then also is the realization through the capital markets rather than through operating companies buying it, just because of the nature of the market and so few competitors?
Yeah, look, let me start with the second one. I think, there are many things that are great and I think better about investing in Africa. I would say most things. The one thing that is not yet, but is getting there is the last bit, so if you have a great company that is doing something in an industry that matters, in a part of the continent that matters at scale and is well run and well governed, ultimately there's an exit for it. So that's not the problem. I think the challenge is that, we've pioneered so many things, we've sort of been first in discovering many things. And I think amongst those discoveries are simple things like, so the reason you might take a company public might be because at some point so you have a company that has, maybe it's got 20 million of EBITDA when you buy it, right? And then you do great. And it's sort of 80 million of EBITDA when you're ready to sell it. Well, now all of a sudden it's a $500 million, $700 million business. And then you've got a real question to ask. Well, not only are there, because there are no other private equity firms, specialists, who might be buyers, although increasingly firms like TPG, Blackstone, et cetera, depending on the kind of business, might be interested, but by and large, not really. And what you might find if you're not careful is that even for strategics, maybe they don't want to write a $700 million check into Kenya or Egypt or wherever it may be. So I think that there is such a thing as sizing an investment for a market, right? Now, if you have a multinational business like Vivo, which is in many countries, then someone might buy that because, okay, look, I'm getting the entire kind of geographic spread. But look, but I do think that, I do think there is something to what you said. The combination of check size, country coverage, etc., is something one needs to optimize. I think I feel pretty strongly that we're getting there. But I think historically, you've sort of seen some companies that we've invested in that we've taken public that actually, had they been a bit smaller, or we would have just sold.
Yeah. So my final question for you, and you've been so generous with your time, and I've loved this conversation. I have sat in your seats at Chelsea, which are incredible seats. My question is, what happens to Chelsea, and are we going to find that Tope Lawani is the next owner of Chelsea after Roman Abramovich ends up selling it in this auction?
Yeah. My LPs might call that strategy drift, but hey, if all that means is that they won't invest with me again, I'll take the risk.
Yeah. Who ends up winning it? Who ends up getting it?
I think I have a decent sense. I think so. But look, I think it's I tell you what it won't be. I don't think it'll be any of the sort of the funds, the fund-backed entities. I think the government and the fans won't really have it. I mean, the government will channel the fans because they're politicians. And so I don't think it'll be that. But I do think it'll be an American buyer. I think almost certainly will be an American buyer. And I think because the American buyers understand the business of sports, I think better than most. And they in particular understand the business of stadium redevelopment, which Stamford Bridge, needs and has a great opportunity for. I mean, Stamford Bridge seats 42,000 people. Old Trafford, where Man United plays, I think 74. Anfield is, so there's a huge upside, to that. And look, when you're the biggest team in the biggest city in the biggest sports in the world, I mean, I think the Chelsea brand is a pretty strong one. But we'll keep winning on the pitch. We won 5 in a row since all this drama began. All on the road, by the way. So it's business as usual.
It's fantastic. I can't wait to come back and go to another game with you.
No, you're always welcome.
You and I we did not get to talk about NBA and your partnership with the NBA. That's going to be for another day. Sure. But Tope, A, congratulations on all you've done. B, thanks so much for spending the time with me today. And most importantly, thanks for the friendship. And I look forward to seeing you soon. And we have not done a shout out to our buddies, Little Johnny and friends, but to Little Johnny and friends, we look forward to
all up and to the right.
Exactly. You got it. Yeah. All right, guys. Thanks, Tope. Great to see you, buddy.
Take it easy. Thanks very much for having me. All the best.
Yeah.